Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And all right, I'm Michael Hartzman. Today is Tuesday, November 9th, 2021. And as always, I'm on with my partner, Dominick Tavella, broadcasting live from Long Island. How are you, Dom?
Good evening, Mike. How are you?
I'm all right. So we had daylight savings time last week at this time. We were both talking with a brilliant sunset in our background. And now it's nighttime, just like that.
I still haven't figured it out in my 60 years. I still don't know how this makes any sense whatsoever. And but yet, it's something that they institutionalized a long time ago, and I guess we'll live with it for a little while longer.
It's not your job to figure it out. It's just you just have to make sure that your watches are set correctly and you show up on time on Sundays.
Well, don't miss the football game, and yes, dinner. Do not miss dinner. So.
Exactly. So look, we in the past shows, we've had a lot of portfolio managers tell us that there were more green lights than red lights. And last week, there was certainly all green. There was no red lights at all last week. The S&P was up 2.03. The Dow was up 1.43. And the NASDAQ, Dom, last week was up 3.08 just in 1 week.
3%, Mike. So,
1 week.
I guess the positive in this is that we literally have been speaking about this with some really intelligent, very educated, very sophisticated portfolio money managers, but probably 4-6 weeks, right, mm-hmm. Mike? We had that little dip about early October. The markets had historically, that's the time of year when things kind of get a little wishy-washy and the markets pulled back 6-7%. And we were optimistic on that, right, Mike? We thought that would be a perfect buying opportunity. Fortuitously, we did. We were pretty aggressive in trying to put money back into the market, back in our portfolios. And gosh, we've been rewarded for that. The client portfolios are doing phenomenal.
They are doing phenomenal. And we've been cautiously optimistic right along. But I have to tell you, Dominick, I was on the phone all day today, and I had so many clients and potential clients say to me, I don't know why this market continues to go up. So I think it's kind of healthy that there is this pessimism still out there as opposed to euphoria. But there more clients than not just say to me, you guys just keep doing what you're doing because we're going to get hit in the back of the head soon. I mean, that's kind of the general consensus with what I'm hearing. What are you hearing?
I would say almost the exact same thing, Mike. It's like markets can't keep going up. There doesn't seem to be anything supporting this. And we're going to talk to our next guest about this specifically, but earnings, and they've been phenomenal. 80% of the companies that have reported so far better than expected earnings. And the Fed basically has been supportive and continues to be supportive. Even the big announcement that we were all kind of frightened about this week, generally speaking, they're going to start the tightening cycle. They're going to stop the slowdown and eventually stop this quantitative easing, but they left themselves so many open doors to switch gears and switch strategy that it didn't spook the market. So strong support by the Fed. Fiscal spending, we just got another bill by Congress putting more money into the economy. COVID doing much better, cases rolling down, and then throw in corporate earnings that are figuring out how to deal with inflation. So far, so good, Mike. So far, so good.
You were referring to the infrastructure bill, and I think the other good thing about the infrastructure bill is a lot of the bad stuff in terms of tax increases and ways to pay for it was really negotiated out. So the bill is not as enormous, which I think is a good thing, as it was going to be. And a lot of the the tax hikes for corporate America and maybe even capital gains, what still might go up, but the spooky numbers, Dom, are not being discussed like they were.
So again, this is a glass half full, half empty. The infrastructure bill, pretty clean. Not obviously they call it infrastructure, but I think a third to half of it is actually infrastructure. Everything else is Congress just spending money away. It's this next bill, their social infrastructure bill, that potentially could have some bad news for corporate taxes and personal individual taxes. But as you hinted, a lot of that has kind of been negotiated out. We'll see whether they pass it or not. A lot of us hope it doesn't. Let's close the year out. Let's move forward with a fresh view on where the economy is and where the economy really needs this extra spending. It's this next bill that could be the problem child.
Right. And hopefully, as I said, and you said, hopefully it's not as dramatic as they want it to be. And I don't think it will be. I think they're going to have to negotiate it down a little bit. So tonight's guest, Dominick, is Duane Roberts. He's the Chief Financial Officer. I'm sorry, he's a CFA is what I meant to say, and Director of Equities and Portfolio Manager for Dana Investments. Dana is a partner of ours, manages some of our equity portfolios, and we're looking forward to hearing what Dana has to say.
Very large institutional money manager. I believe the number is in excess of $7 billion. So we have a very interesting guest tonight. They'll give us some insights.
We'll be right back right after this break.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, LETAX.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors Private Wealth Advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella and our special guest this evening, Duane Roberts, Director of Equities and a Portfolio Manager with Dana Investments. Good evening, Duane. How are you?
I'm very well, thank you. Good evening to you.
Thanks for joining us, Duane, and I can't wait to get into some of your insights about what's going on out there.
It's my pleasure to be here.
So, Duane, I know you heard the conversation between Dominick and I a few minutes ago. What's your take on where we are right now? The week that we had last week, was that an anomaly? Do we still have some potholes ahead, or how do you think we're going to close out the year?
Well, I think there are always potholes ahead, but I don't know that last week is an anomaly. I think last week was relief that the Fed meeting went about as well as could be expected. I mean, the idea that we're going to start tapering on quantitative easing was well projected and certainly expected, but there was a dovishness to how that was communicated. And I think that the dovishness is supporting the concept of this liquidity-driven market that we're in. So, there are a lot of positives in the market. You talked about it in your opening segment that, look at what's happening with corporate earnings, how quickly they've rebounded from the very brief recession that we had, and that the earnings growth continues to look very positive. Now, some of that is slowing down. But the growth numbers are still positive and still above, long-term trend, or at least recent long-term trend. I guess that would be intermediate term trend. I'm thinking, the last 20 years. And so, I think corporate earnings are going to continue to drive things. The monetary side has been supportive really since 2008 and continues to be supportive. And we didn't get anything communicated last week that indicates that there's going to be any kind of abrupt change in that. And then, as you were discussing a few minutes ago, the fiscal side. And we've had a huge amount of spending over the last 18 months. And now with, the end of last week, getting the basic infrastructure bill passed, that I think it will continue to be good news for the economy and for the markets. And then the expanded infrastructure bill, I was pretty skeptical about it a few weeks ago. I'm becoming more optimistic that something will be done. But I think, again, to what you guys were talking about earlier, the reason I'm more optimistic something is going to get done is because it's been negotiated down to where it is a much more moderate bill, and more palatable to at least the entire Democratic Party, which it needs to be. I don't think they're going to get any votes on the Republican side, but you even had resistance within the Democratic Party for a while, and I think they're negotiating enough to overcome the extremes within that party, on either side, the moderates and the progressives, to a point where I do think we'll get something done. It may be even further limited than what we're talking about today, or what we hear just reported on today, but I am more optimistic that something will get done. The bottom line, though, is that between those two bills and what we've already seen passed and spent, this has been a strange recession. The recession of 2020 was a strange recession, and that we actually saw disposable incomes go up because of the transfer payments. And so that's been very supportive of risk assets. The Fed has certainly been encouraging the success of risk assets. And so I see that continuing for at least several quarters. The earnings side, I think, will continue for many quarters. And so I think it is a good place to be. And last week just was maybe a little too strong in its positive direction, but I think directionally it was right. And I do think markets will remain strong. There are some areas of concern. I do think there are some areas of speculative risk, and I think you've seen some of that even just today, for example, with the pullback in Tesla. But still, I don't think anybody who's been a long-term Tesla investor, and by long-term, I mean anybody over 3 months, is complaining by what we've seen today.
So,
because
Duane, let me be the devil's advocate on exactly that point. So I don't know how many CEOs or company heads I've seen where they've beat on the top line and they've actually even beat on the bottom line profit for the quarter, but they've talked about higher input costs and their ability to pass those higher costs on to the consumer, and the consumer willing to spend that money. How long does that continue? How long before the consumer says not enough, I'm not doing it anymore, or companies just don't have that ability to pass on the higher cost?
Yeah, so that's, probably the one big universal fear in the markets right now is inflation. And, is it transient or not? I'm in the camp that it's not, but I also believe that it's not going to be so severe that it derails anything in terms of the success we've seen. So our focus has been looking at companies is to try to identify, where are the companies that that have been able to manage their supply chain disruptions and the costs associated with those. Where are the companies that are able to pass those increased costs on to customers? And I look at just something as basic and unglamorous. I mean, so much of what we've seen over the last 5 or 6 years, you've got to be a high tech 30% revenue growth per year company to get much attention. But I just look at the automakers, GM and Ford, and both of them have been performing quite well. Tesla clearly has been outperforming those because it's the tech darling. But GM and Ford have been doing quite well. And despite the problems that they've been faced with, their margins are actually doing quite well because while they're not able to deliver as many autos as they'd like to be delivering, it means that they're not discounting anything. And so, when demand exceeds supply, that usually is pretty good for the person doing the supplying. And in that case, Ford and GM are seeing some fairly strong trends. Now that'll start to weaken as the supply chains become unclogged, particularly on the semiconductor side. And we may see that there's some weakening of demand from the lack of stimulus, but the fiscal stimulus is not really slowing down. It's gone from kind of the emergency COVID spending to now these infrastructure bills. So, I think that there's still going to be plenty of fiscal support. We think the monetary support will go well into 2022. And so, I think that imbalance is still going to favor the demand side is still going to exceed the supply side for a while. So I do think you're going to see many businesses that, at least in the short term, meaning the next year, are going to be able to pass those costs through. Now we'll see what happens after. We'll see what happens with the labor picture. That's probably the bigger concern to me, is what happens with labor inflation and labor availability. And that to me could be there's certain industries where labor issues could be the factor that upsets the trends that we've seen.
Duane, just getting back to the infrastructure bill, when people hear infrastructure, I think the first thing they think of is tunnels and roads and bridges. But if you correct me if I'm wrong, I think this infrastructure bill also includes money to build charging stations for EV vehicle, electronic vehicles,
Electric vehicles, right?
Universal Wi-Fi. So I think this infrastructure bill is a little, I'll use the word sexier than an infrastructure bill 20 years ago, where money, would have been just ready for shovel-ready projects to shore up our bridges and roads. Is that correct?
That's correct. And if you look at I don't remember the exact statistics, but it's a minority of the spending in the basic infrastructure bill that was just passed is going to roads and bridges, which is what most people think of.
I think the actual number is about a third of the bill.
Yeah, it's much less than half. So,
right.
So the rest of it is Michael, as you were highlighting some other things. I mean, there's transportation systems, so ports and airports and things like that. There's the electric vehicle infrastructure, the broadband piece of it. There are many things that traditionally haven't been thought of as infrastructure. And then when you get to the second bill, that broadens even further. And so, I think that's been part of the political debate, is what does infrastructure actually mean? But I think, certainly broadband. I mean, think about the last year and a half to 2 years. The businesses that have been able to continue to operate with the least amount of disruption did it virtually. Education did it virtually. And all of that relies on significant infrastructure in terms of broadband internet access. And so, the U.S. in my opinion, could be stronger in terms of the infrastructure we have to support broadband access, particularly in rural areas. But even in, even more broadly than just the rural areas, I think, there are areas of education, for example, became a challenge for certain parts of our population because they didn't have adequate internet access. I know, even personally, occasionally here in my office, but certainly when I'm traveling, it's extremely frustrating to be in a place where you have unreliable internet. I mean, you may have what claims to be high-speed internet, and it is high speed most of the time, but you'll get these periods where it'll drop out for a few minutes and gets really sluggish. So that kind of infrastructure, I think, is really important to our long-term economic well-being. And so, I do think roads and bridges are also important. But I know in my area, I live in the Dallas area, we've been building a bunch of new roads and bridges here for more than a decade. I'm not sure how much, basic infrastructure spending additional. I mean, there are more things we need, don't get me wrong. But I don't see this bill as significantly impacting that part of our infrastructure, where I'm hoping it'll have more of an impact or on some of these other forward-looking infrastructures like, the utility grid, the electric vehicle charging network, broadband. I do live in Texas, and earlier this year, as you probably heard, we had a significant issue with our utility grid. And so that kind of infrastructure needs to be upgraded. And, we had warnings here in the state of Texas years ago with a similar, less severe freeze. And reports were written about it, but nothing was ever done adequately to follow through to develop the infrastructure. And it's not just the renewable infrastructure; it was the fossil fuel infrastructure as well, that shut down because pumps were freezing and other things were freezing. And so that type of infrastructure investment is important, and it's important for us as investors to be able to take a long-term view. We get so short-sighted on quarterly earnings reports that sometimes we miss the fact that a little spending today may pay off significantly in 5 years or 10 years. And I think, Dominick, you mentioned that we may talk about some of the ESG things later on. I think that's one of the big advantages of having an ESG perspective on things is it does take a longer term view and gets rid of that short-sightedness that I think is frankly probably
Duane,
overly common.
You guys went through it in Texas and with the power grid there, and we certainly had our issues up here in the Northeast when Sandy, the hurricane, came up and flooded out a lot of systems. And I think one of the bigger criticisms about this particular bill is that maybe a little bit more money should have gone in direction of building up our existing infrastructure like we just described, and maybe safeguarding it for future generations. But it is what it is, and we just need to make decisions going forward.
Yeah, no, one of the utility companies that we're invested in is your Connecticut services your Connecticut neighbors, and I remember the issues they had in 2020 with disruptions that caused us actually to really dig deep into that stock and decide whether we wanted to keep it. We did elect to keep it, at least for now, because we do think they are doing some things on with a longer term perspective that look good, but certainly they had some issues that the existing infrastructure couldn't handle with the flooding and the storms that you guys got last year.
So when clients ask us, why do we bring these issues up and how does it affect me? This is exactly it. This is how we live and breathe every day. And some of these issues are not being addressed, both for our well-being, but also from an investment perspective. Does it make sense? And this is an area where do we want to allocate some dollars? So that's why we get to speak to you.
Hmm. Yeah, no, it's all of these things are important, and you know, there are different time frames. I do think the public markets tend to focus a little too short on the single quarter, but you know, there are things that play out over 18 months, and then there are things that are going to play out over 5 to 10 years. And as investors, we need to keep all of those time horizons in mind. And frankly, I think the longer term horizons give you clearer vision on what you really need to be doing and how you should be investing.
So Duane, on that note, you know, we spent the first half of the show looking at the market from 50,000 feet in the air. When we come back after this break, if you could stick around, we'd like to get a little more granular on some of the funds and some of the portfolios that you manage and some of the interesting things that you guys are doing, especially with ESG.
Okay.
All right, so we'll be right back right after this break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella and Duane Roberts, our guest this evening from Downer Investments. And Dom, I know you and Duane go back a little further and have some great experience with Downer's ESG portfolios. So I'm going to throw it over to you and let you get into that a little bit with Duane.
So Duane, I know you guys have been doing this for a very, very long time, and way before ESG was sexy and in the headlines every day. So maybe just a little bit, what is ESG for you guys? What does it mean? What sectors you would avoid? Why is it at the forefront of the news these days? Maybe just a kind of a generic picture of it all.
Sure. So we've been doing it, as you mentioned, for a while, for over 20 years. And it was initially done at the request of a client, quite frankly. And so we had to kind of dig in a little bit and learn what that meant. And you know, we started, so I think ESG, environmental, social, and governance, these are factors that are starting to get more and more attention. So this ESG integration, ESG approach to investing is getting more attention under that name. But you know, I would argue that good investors have been paying attention to these non-financial factors for decades. This is not new. The other way of looking at it is that it tends to be kind of values oriented. And that's really what started us down this path, is the clients bringing a values mandate to what we were doing. And so, I think you need to think about it in two ways. One is, are you specifically looking for kind of to align your investment portfolio with a set of values, your values, so that you feel like your investments are supporting more than just financial returns, but other returns, non-financial returns as well. ESG integration, though, I think grew out of that because a lot of the values-oriented investors were looking at these environmental issues. They were looking at social issues. They were looking at corporate governance, and starting to pay more and more attention and pushing on some of those things. And I mean pushing, meaning interacting with the companies they invested in to try to improve corporate governance structures, for example. And so, it was kind of that values base started a lot of what we refer to today as ESG integration. But ESG integration, I think, should be applied by every investor, whether you have a values mandate or not, because again, just like going back 40, 50, 60, 70 years ago, I mean, I think, Benjamin Graham probably would have thought, yes, of course I pay attention to corporate governance. Of course, I'm going to pay attention to how well a company is interacting with their labor force on the social side. I am looking at the consequences of what are the long-term consequences of pollutants that could come back and be some sort of financial liability. So in some ways, whether you're values driven or not, paying attention to these factors are important. And that's what is, I think, driving ESG into the mainstream, is that it may have been a focus for values investors over the last several decades, but in the last decade, it's become more and more clear to the mainstream investment community that we should be paying attention to these factors, even if it's not a values-oriented or a values-mandated portfolio. So yeah, ESG we think is just very important. It's a broader way of looking at things, and I mentioned the time frames earlier. I think ESG forces you to take a longer perspective on the time horizon, which, as I mentioned earlier, is beneficial to, in my view, it's beneficial to investment performance. I think that short-sightedness leads to over trading, which quite frankly, there's a lot of studies that show that highly traded accounts tend to underperform those that are less highly traded. And so the longer term perspective, I think, helps people understand what their goals are, helps companies understand what their strategy is. And ESG forces some of that longer term perspective.
Duane, when you look at ESG, is ESG a concept, or are there sectors that someone who's a devout ESG investor, there's going to be a hard no? Meaning, are there tobacco and alcohol companies in an ESG investment? Are there gun manufacturers in an ESG investment? I remember many years ago, I bought a client the S&P 500, and they called me up and said, well, Walmart's in the S&P 500 and Walmart sells guns, sell my S&P 500. So I talked them out of that. So my question is, as I said, is ESG a concept, or are there truly certain categories where you just cross them out?
Yeah, so it can be both. Again, it depends on the client. So we have clients who tell us that they don't want to invest in certain things. So tobacco would be one of them. Gun manufacturers would be another. So you picked a couple of examples there. In the case of someone like Walmart or even a Kroger, for example, Kroger bought a company years ago called Fred Meyer, which is out in the Pacific Northwest, and they're kind of a general store, and in rural Washington State, ranchers use guns. And you can buy one at a Fred Meyer. So all of a sudden, Kroger is selling guns. Is that necessarily something that you would want to preclude from your portfolios? It's really a client-driven, in our perspective, it's client-driven. Because I would argue that you can do ESG investing and not eliminate anything, right? So you could look at, okay, Walmart sells guns, but are they doing it in a responsible way? Mm-hmm. For some people, that's an oxymoron, perhaps a contradiction. But are all the laws being followed? Are they avoiding selling to minors? There are things that can be done. And you can push companies, again, engaging with companies as part of ESG investing, in my mind. So having a conversation with Walmart about their practices in terms of gun sales, or with Kroger, and we did have those conversations with Kroger years ago. That's something that I think is part of ESG investing, and it doesn't mean you stop investing in Kroger because they now have this. A few stores, more than a few, but relatively speaking, a few stores in the Pacific Northwest that sell guns. I think a clearer example, one that's probably easier to relate to, is this push to divest from fossil fuel producers. And so while we may agree that long-term reducing fossil fuel use is good for everyone, how we get there over the next, in the short term, over the next 5 years, is a challenge. And in certain areas, in certain developing countries, fossil fuels may be the only source they have. And so how do you balance those needs of in certain areas where there is a need for fossil fuels, at least in the short term, versus a desire to eliminate. So we have clients who have elected to divest from that, but our generic approach to fossil fuels is that one of our investment tenets is that we're sector neutral in all of our portfolios, in most of our portfolios, where there are some exceptions. But by sector neutrality, I mean, we've taken this point of view that we can't outsmart the market in terms of allocating to energy versus tech versus healthcare versus utilities. So we don't even try to do that. And then we focus within each of those sectors on what we think are the most attractive, fundamentally based companies. And so within energy, we're going to match the market weight, which is currently pretty low, roughly 2.5% of the S&P 500. So we're going to have low exposure to that. But that means we're going to have 2.5% basically exposed to fossil fuels, because the alternative energy companies are all classified in other sectors. They're not actually in the GICS energy sector. So by doing that, we're going to engage with the companies we invest in. How are you dealing with the methane problem, for example? The methane release in certain processes with oil and gas production can be worse than the actual burning of the fossil fuel itself. So our companies taking efforts to deal with those problems, to deal with the greenhouse gas effects of the production itself before the fossil fuel even gets burned. And so that's one example of taking a holistic point of view, that we're not going to say we're just not going to invest in fossil fuels, but instead we're going to invest in fossil fuels, and we're going to push that. We're going to invest in the companies that we think are producing fossil fuels in the most responsible way, and push them to be even more responsible. And then, within fossil fuels, you've got, coal, natural gas, oil, the three big areas, and they all have different environmental impacts. So we have chosen not to invest in coal for decades. And it's not, but we've made that choice because we felt that there was a financial risk to those companies, as that demand was going to drop faster and sooner than natural gas, for example. And so, paying attention to these issues from an ESG perspective maybe helps us take that long-term view that told us 20 years ago to stop buying coal, and has now got us engaging with the gas companies that we do invest in, on how they can be more responsible in how they produce that, and what their plans are going forward long term. So one of the things I'll just mention, I won't mention the specific company, but one of the larger integrated oil companies we owned for many years, and had lots of conversations with them and how they were managing their environmental impact and the transition away from the heavy dependence we have on fossil fuels in the past. But we elected to sell it because if you looked at their capital budgeting kept showing that they were committing a lot of capital to 10-year, 15-year, 20-year projects to develop new sources of fossil fuel. And at some point, we think the return on those investments is not going to be what it has historically been, because we do think that there's going to be a long-term change in demand for the sources of energy. And so we're avoiding the companies that, in our view, don't see that long-term picture as clearly as they should.
So Duane, we got to know each other literally some 20 years ago when we were looking for a socially responsible fund. That's what we called it in those days. Now it's ESG. But isn't that one of the problems today, that ESG means different things for different companies, different things for different investors? And how do we wrap our heads around that ESG for you and me might mean something completely different from other investment houses? And then how do the regulators put their hands around all this and try to bring it in a way that it's transparent to investors?
Yeah, I do think that the three of us would have different definitions of what it means to be socially responsible. And so, there's this difference between values and value. So a values investor might say, I don't want to invest in any company that has anything to do with guns, to use an example we were using earlier. A value investor says, well, I'll invest in a gun company if I think that long-term they have value. So ESG can be applied by both, whereas SRI, I think, was really more focused on the value side. So, our learning about ESG at Dana really came about because we had SRI clients, and it forced us to really dig deeper on environmental issues, corporate governance issues, and it was a great benefit to us early on. If you think about kind of the early 2000s, coming out of the tech bubble of the late 90s, you had quite a few corporate governance issues, shall we say, at companies like WorldCom, Enron. And if you could use corporate governance research to avoid some of those, it really helped investment returns. And so we noticed right away that while we were doing this because of the social requests of our clients in that SRI vein, we found that it was helping us make better investment decisions. So I think ESG, to me, is just the broadening of SRI to go beyond values and to include the value side as well. And that's why it's gone mainstream, is because everybody should be a value investor. And so ESG can help you be a better value investor, be a better investor. And so, I think there is a distinction between the values and the value, and different people, certainly on the value side, different people are going to have different perspectives. On the value side, in the long run, we should all be wanting to achieve the same thing there. Now, in the short, our horizons may cause us to come to different conclusions on individual securities. But in the long run, everybody sees value the same way from a financial perspective, whereas values can be very different from one person to another. And really that has to be bespoke to the individual client. We've tried to take an approach to that gets at a consensus, but it is, each client is going to have their own view on it.
So Duane, we're just about out of time. And to that point, I would also assume that ESG could also be very regional. You're down in Texas and there's maybe a different view of the gun laws than we have up here in the Northeast. The folks in North Carolina along Tobacco Row, they may feel entirely different about their ESG criteria if they're tobacco producers. So again, I would assume that ESG can sometimes be regional as well.
It can, and I think, you look at, particularly in the SRI early stages for us, but the SRI era that kind of transitioned into ESG in the last 10 years or so, that was very much true. You had SRI was very common in the East Coast and the West Coast, and maybe not so much in the middle of the country. But now, again, using energy as an example, here in Texas, energy is an important industry here. But yet, even within Texas, you see even people involved in energy understand the consequences of the fossil fuel energy production and consumption that we have, and are looking for ways to manage that transition. So I think ESG has actually broadened it and removed some of that regionalness, but it is true. I do, on the tobacco side, though, I don't know if any of you remember John Boehner, the former Speaker of the House, in his book that he released last year, he actually has an episode where he was on the board for one of the tobacco companies, and he went into the board meeting, and Boehner was a chain smoker. And the people in the boardroom were telling him that this is not good for you, and none of them smoke. So, I think some of the regionalness in the long run goes away. Even I can think of other examples of foundations and other sources of wealth that maybe generated it from one source is now recognizing the consequences of that source and are pretty active at trying to address some of the externalities that come about. So tobacco is one, energy is another. I'm sure we could come up with other examples. I know two very specific instances of those first two, though.
Duane, we are unfortunately out of time. We'll definitely have to have you back, and thank you for this evening for making the time for us.
Well, thank you. I hope it's been a pleasure talking with you both, and look forward
we
to
literally
our
just
ongoing
touched
relationship.
the tip of the iceberg, Duane, but I am looking forward to doing this and continuing the conversation. Thank you.
Thank you, guys. It's been a
We'll be
pleasure.
right back. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the funds is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For
taxes.
your cash,
More
ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella. Dom, my takeaway from my conversation with Duane tonight is sometimes you and I lose sight of the wide net, what we do, the wide net that gets cast in the people that we get to talk to, in the decisions that we're responsible for making, and just all the subtleties. Like you said, it's not cookie cutter. We use the word socially responsible and ESG, and people think, oh, it's that. Then we get someone like Duane, and it's that times 17. There's just so many variations.
And moving parts and trying for us on our side, making decisions and making allocation changes and figuring what part of the environment we want to focus on. And so it's an ever evolving process. I think it is truthfully one of the things I love most about this job. Every day is a new day. Every day is interesting. Every day is a curveball. But, oversimplifying it, Mike, maybe a little bit, being a good corporate citizen at the end of the day means the stock price, the value of your company goes higher. And if you decide that you want to pollute or not treat your employees right or do something inappropriate, your stock price gets hammered. And in some cases, we've known companies that have had to file for bankruptcy. So being a good corporate citizen, we can call it, we can label it anything you want, but it's a good thing. It's a healthy thing for the company. It's a healthy thing for the shareholders.
I remember, and I don't know how many years ago it was now, but when I first heard the expression, what's a company's carbon footprint? I remember it was mocked and it was made fun of, and what is that? And oh, it's just a bunch of tree huggers. And you know what? Every company now has a way to measure their carbon footprint.
And look, what's the harm? I mean, there obviously is a cost factor to companies doing this and then trying to minimize their carbon footprint, right? So there is a cost factor to this, but also being a good corporate citizen has intrinsic value, whether somebody's willing to buy your product, use your product, invest in your company's stock. There is an intrinsic value to a company being a good corporate citizen and not blowing up a tanker in the middle of the Gulf of Mexico, or pollution, or again, mistreatment of your own employees or your own customers. So we can argue that there's a cost factor, and maybe that money should be used in a better way. And that's an argument we hear all the time. But what's that value added because the consumer appreciates you as a good citizen company and uses your product, right? That's not always an easy to measure thing, but simplistically, good corporate citizens for us, generally speaking, are good investments.
And even it's a little things, even tonight, and how we've been doing this show for a better part of a year. You know, you're sitting on one end of Long Island, I'm sitting on the other end of Long Island. When we go home, you're going to go further east, I'm going to go further west, and neither one of us had to drive to each other to do the show together. We didn't have to drive to a studio to do the show. So even companies like Zoom and GoToMeeting, you know, these are companies that reduce the carbon footprint overall, one little tiny drop at a time, but it all adds up.
It adds up, Mike, and as citizens, and we hear this all the time, right? We're looking at our own lifestyle and we're looking at our own life decisions and going, is this the smartest, most productive, most efficient way to operate and function? And, you know, we live it daily, right? And you think of one plastic cup at a time, or 1 mile less driving and fuel usage, or buying an electric vehicle. We could sit here and argue why a Tesla is worth X amount of dollars or some other stock. But at the end of the day, it helps the quality of life, and there is a value to that, right? And in this case, there's a financial value to it.
There is a financial value too, because I do think more and more investors are paying attention to the value proposition. As Duane said, it's values versus value, the value proposition that these companies have, and are they committed to it, or is it just lip service?
I met the people at Dan, as I mentioned, 20 years ago for a client who was looking for a socially responsible fund. Seemed like a strange concept over 20 years ago. Today, it's part of our norm. And Dana's ESG portfolio, which is our Lebenthal ESG portfolio, tremendous track record, terrific people, done a wonderful job for us. And now it's mainstream for us, where clients come to us, ask us for it, and we have it, and it's already built. So, you know, it's a full circle that comes around, but it's amazing that it started 20 years ago. Here we are today.
Exactly. So Dom, on that note, we are out of time again.
Somehow.
So,
hey, Mike, great conversation tonight. One we definitely have to pick up the ball on and come back to at some point in the future.
I think we definitely will. I think we'll have Duane back. But on that note, Dom, you have a safe trip home east, and I'll have a safe trip home west, and I'll see you down the road.
We'll talk again tomorrow, I'm sure. Have a great evening, Mike.
Have a good night, everybody.
Thanks for tuning in to the Lebenthal Report.